Hi everyone, welcome to this live event. As usual, I'm here for a few minutes to share with you my views of what to work with this week in the Forex market. So as usual, also, I will start by sharing the calendar, the macroeconomic calendar. I guess you have it. Let me see. No, you don't. You're having my charts. Give me a second. There we are. Okay, I'm not sure if you can see it. Okay, I believe so. And well, there's no surprise that this week again the main attention of the market will be focused on central banks. We have the Bank of Japan yesterday, the Fed tomorrow, the Bank of England on Thursday, and pretty much the Bank of Japan did little for the market. It has except some certain assets from the negative rates, but for the most deposits, right? But the most it has left the policy unchanged, and the Bank of England next Thursday is hardly expected to do anything, right? We're going to see them keeping rates on hold, the assets purchase program on hold, and probably probably give no news, no new outlook, right? To take care of nothing. We are in the tightening part, or we are planning to change anything. Of course, the main event is the Federal Reserve on Wednesday. It's a full meeting, the ones that had the dot plot and the statement of and the press conference. Sorry, of Jalem. Sorry, I'm slow mo today. Anyway, um, I was trying to take something short out of this, and it's not easy. The Fed has left the easing path, right? The opposite direction of what the rest of the worldwide central banks are doing last December. Agreement has been appreciating ahead of that announcement, right? But all of a sudden, over this first quarter of 2016, sorry, we have news that the Fed, that the things are not going that good in the US, right? We have some poor GDP readings, inflation remains subdued, employment has been not as good as expected, although still strong. So overall, there was a small slowdown in the economic picture in the US, who, and that forced investors, to price in the possibility of a rate hike being delayed towards next year, right? Despite the Fed has said in December that there's a good chance that it will raise rates this year for at least 3 to 4 times, right? So what happened then? It's like a going to bed story, this one. But anyway, things are not that bad in the US, as we lately have known from macroeconomic analysis. And therefore, there is a chance that they may raise rates in June. Okay? We are not expecting nothing for this March meeting. All the attention or all of the expectation of a move is focused in June. But what we are going to take a look at in this particular meeting, what we will be watching for in this March meeting, is the dot plot where they usually anticipate the forecast, right? What they are what they are going to do with their economic policy, how they see inflation, how they see employment, and the different sectors of the economy. I believe that if the Fed is still, or most members of the Fed are still considering the fact that the Fed will actually raise rates this year for at least 3 times, the dollar may come back, right? It may begin to regain the ground lost over the past months and give back this negative tone we are seeing these days. But of course, it's something we can't anticipate right now. It's something we are going to see on Thursday. Earlier, before the meeting, the US will release its latest inflation figures, as you can see in the calendar, but I don't believe they are going to have much effect, right? Particularly if they come in line with expectations, which pretty much what it has been over the past few months. If we have an uptick in inflation, that will be a first clue of dollar strength ahead of the Fed. And of course, the tone of Chilean and the dot plot, whether if they are dovish or hawkish over the future, will set the tone probably for the rest of the week. As I was saying, on Thursday, we have the Bank of England, right? And we also have the Switzerland National Bank. You know that ever since the peg and the lift of the peg, the Swissy has been mostly left aside from traders, or because it has been quite a wild ride, quite a headache, and it's probably not the best currency to trade, given that despite we have no news of that, it's clear that the Switzerland National Bank has been intervening in the markets and doing some sort of whatever it takes to, uh, sorry, to take down the value of your currency, right? Anyway, uh, this time, I believe that this particular meeting is going to be closely watched because the ECB has launched all its full armor last week, right? Of course, it was not enough to weaken the euro. Maybe it backfired on Draghi. But anyway, the risk is that the euro may fall, may drop. Uh, After all this, easy money has been announced, sorry, and we will start in April. Stocks have been reacting pretty well to the news because European indexes have been steadily rising, except for today. But maybe it's some profit taking ahead of the upcoming events, who knows? But anyway, I'm suspecting that Switzerland National Bank would take some action, okay? And they may probably cut rates farther into negative territory. So take a look at that, beware of that, because it will, of course, affect the euro earlier Thursday, okay? And pretty much that's it, what we have from the macroeconomic calendar that can actually affect the trends. We have Canadian inflation on Friday, but I still see the Canadian dollar dependent oil prices rather than sales data. Okay. Anyway, let me share my charts. Here we are. Okay, here we are. As I was saying, stocks had been rising, but have retraced some today. Anyway, they remain sharply into gains above. This is the German DAX. It's like a reference, right? This is the rally slump. Quickly reverted, and we're still above that level. So, and a fresh monthly highs in the situation replicates in London and in the main US benchmarks. So, for most, the outlook is positive for stocks, at least at this point. And as I was saying, I believe that these movements are profit taking, right? When it comes to the euro, I have been following this latest rally, the ECB one, right? And the fact is that I can't place it there because it's too short. There it looks better. And the fact is that despite the pair has lost some upward potential, right, according to intraday technical charts, it's still above the 38.2% retracement of that rally. So my take is that we need to take down the 1060 region in the short term at least to see the pair back towards the 110 figure. Okay, if we lost that level, then the risk will turn back towards the downside. And on the other hand, and always talking about the short term, 1120 has proved strong so many times over the past year and is now the 23.6% retracement of the same rally, which means that some follow through or above the level, candle opening and some rally beyond it is required to revert to see the pair regain the upside, right, and retesting the 1220 region that we test on Friday. If we take a look at the longer term outlook, right, the pair is still struggling to hold gains above its moving average. I was watching the brown one is the 200, the red one is the 20, this one is the 100. Simple moving average, right? And yeah, the price has been struggling above and below them, but they are horizontal, right? They are flat. That's telling me there's no clear trend in here. And I don't see a trigger beyond another surprise from the central bank, probably the Fed rising rates being able to trigger a real directional trend. So that's why I keep on with the short term with the euro. Honestly, I can't tell you if we are going to see levels below 800 or above 112.40 first, right? We are there midway, going back and forth, and unless some of the currencies of these two currencies actually get strong, uh, there's nowhere to go, right? And I do believe that my personal view is that dollar has more chances to go higher than the euro because of the imbalance between central banks, right? Becoming more notorious than what it is these days. Okay. And for the pound has been pretty wild towards downside today, right? I do believe that we reached a major resistance level last Friday. This is this year rally, right? Bearish one between January high and the 38 35 were post in late February, right? That's the Fibonacci. And take a look, we have reached the 61.8% of that fall and start this bearish movement back. So overall, that's telling me that in long term, the bearish trend prevails, and what we have seen has been a corrective movement, and there's still room to go back towards the downside. Probably 140 is a line in the sun. I do believe that the market does not feel comfortable with the pound below 140, but and there's a good chance that we can break that level on dollar strength, just on dollar strength, not just on pound weakness. Okay, keep that in mind. Anyway, and for the short term, this low right in here 41.10, 41.20 seems to be the support to follow in for today, right? Honestly, I'm not expecting much because if you take a look at the daily charts, we have already traded in usual 150 pips right from the pound. So the downside seems, oops, sorry, a bit limited right now, but the rally can extend now to 141.30 right now. That's the level to watch. And if we take 2041 down to 40, 60, 70, the next probable bearish target, right? Uh, there is some strong resistance around 42.10, 42.30, right? We have plenty of highs and lows in the region, plus a Fibonacci level. So unless we take that level back, I don't see much of an upward potential in here. Additionally, what I always follow as a strong dynamic resistance or support level is the 200 exponential moving average in the 4-hour charts. And despite we had a rally above it, it quickly reverted. And I always care about the candles, right? These long candles, once we broke, and now that higher, and now that we broke lower, had a lot of volume, right? These long candles are telling me that there was a lot of volume in the market at that particular moment, right? So what I'm taking out from this latest decline, I mean, is that bears are, of course, taking care of the pair and pretty much uh, larger than bulls, and that the chances will remain towards the downside, right? When we have a breakout to the upside with this kind of volume, it surely means an upward continuation. Of course, we had it. But of course, we are talking about the 4-hour charts, so we are not talking about the dominant trend or the probable long-term trend, but we are talking about what's going on for the day and intraday, right? Remember that you can, uh, you have to adjust the analysis to the time frame you're doing, right? If you're analyzing the 1-hour chart, you're not able to tell us what's going on in the weekly and where the pair can go in a month if you're just taking a look at the 1-hour chart. Anyway, and for the dollar Japanese yen, what a poor movement we are having in here around that 1350 level. I was taking a look at the weekly chart last Sunday. We have 2 doshes in a row, right? 2 weeks going nowhere, and we're still trading within that range, which is 1210, 1460, 1480, the highest, I believe 85 or so, yeah, 86. So anyway, what I'm seeing in here is that the range is there and it's even shrinking. It can last forever, the dollar Japanese yen does this, but once it's broken and once it sets a direction, it will probably maintain it from a couple of weeks with no retracements, no pullbacks, no looking back. So it's just a wait and see on which direction the pair will break, right? It's just that it's boring, I know it, and probably not the best pair to trade daily basis. But if you take a look at it here and there, you can determine at some point. Okay, it has broken. Here we go. This is bullish. This is bearish. In the meantime, and for the short term, I have little to say, to be honest. We have a short term support around 1260, the base 1210. We can go down to lower set levels, but I do expect some buying interest in here, right? And to the upside, 1460. To be honest, for me, the breakout point towards the upside is 1505, which is the 38.2% retracement of the uh, latest daily form, right? And we have that double bottom forming, but the figure has lost relevance now that the pair has entered in a consolidative stage. It's not worthwhile for me to consider this a double bottom because of all the upcoming developments, okay? So I would say that this pair is only a buy when it breaks above 1505, and probably a buy on dips towards 12, but that's the most I'm making of it. And the Australian dollar, well, this latest decline, it's two-day decline, it's mostly due to the poor developments in commodities prices these days. We are going to jump to oil right now because I do believe it's quite relevant. Anyway, the Aussie has reached 76, sorry, against the greenback this week, a major level, considering it has been pretty much running 800 pips with not much in this way higher, right? So far, this decline seems corrective long term, and I'm not seeing much of a downward room in here because, as we have discussed plenty of times, the Australian economy seems the one doing better, and if it gets hit by poor economic developments in China, right, being affected because mostly, keep in mind that Australia produces a lot of metals, yeah, it's sells iron ore, gold are its major incomes of the country. And its main client is China. So if China stops buying, they stop selling as much as they do, and that could affect the economy. Anyway, uh, overall, I believe that the Australian data has been pretty in line with further advances in the OC. We are fresh 8-month heights, I do believe, of levels not seen since early 2015. So for the most, I do expect the pair to keep running higher with this declines being taken as buying opportunities. Sorry. Short term, I don't expect the pair to keep falling much. At this level, 74, 74.20 could be a nice buying opportunity with a dice stop below it because, yeah, ahead of the Fed, things can blow. If the Fed decides to do something wild. And if we lost that 74 level, I do believe that there's room to go down to 72.50. Right, this region is not much in the way. We have former highs and there are really relevant ones. So 72.50 seems the next probable bearish target on a breakout lower. And still in long right will be just corrective, right? We can recover up from there. Still no long term. Anyway, back to short term. Of course, 75 is now available to take or recover to talk about an upward continuation, right? 75.50 and 76.20 seems for me the next probable bullish targets should the Aussie recover ground. And taking a look at oil, as we were talking about, remember we have said many times that despite this latest recovery after falling down to near 25, uh, has looked pretty strong from a technical point of view, given it's back above its 100 simple moving average for the first time in the year. And so the fact was that the background has not changed. And today, the background remains as bad as it was when the commodity lost almost 100 bucks, right? The last 1.5 year decline. The macroeconomic background is the same. And yesterday we had a couple of negative news one of which was that Iran is planning to rise its oil production before even start talking about a freezer, right? So that means that the market will remain oversupply. And the other negative news was that the OPEC, sorry, and non-OPEC producers, which were planning to meet next March 20, delayed their meeting to April, right? So hopes that there's going to be a freeze or not output reduction had decreased, right? And that's why the oil is back under pressure. Furthermore, the lack of economic activity all across the world. We need a strong industrial production in Europe, in Asia, in America, because industrial production means oil is being used, right? So it's on demand, right? There's no demand and there's higher production. The price will fall. Offer and demand, basic laws of market. So I would expect a break below this region 35, which is not only a major psychological support, but also the 100 moving average, the 21 in the daily. And I do believe that if we take 35 back down, there's a good chance we will fall back towards those lows around 25 we have seen um, earlier this year. Gold, it's another case, another interesting case, right? Everything that gold does depends on the Fed, right? Gold had been plummeting on hopes the Fed would raise rates and began recovering this year after the Fed offered that rate cut finally in December 2015, right? And boosted or helped and underpinned by the fact that US data was negative or irrelevant. Anyway, what we are seeing right now, it's some profit taking ahead of the Fed. I do believe that the market will be on hold, right? Because if the Fed somehow decides to announce another tightening in their policy, the pair will probably sunk back. The commodity, sorry, not the pair, will probably sunk back uh, ahead of further rate hikes, right? It's linked to the Fed. If the Fed stands on hold and offers the dovish stance, well, there we go. We'll probably break that 13 level and 1300 and keep on running. So beware of that. Beware that gold, sorry, will become a pretty interesting asset to trade after the Fed, right? It will probably set, not probably, most likely set the turn in there. And I believe that pretty much I have covered my favorite pairs and all of the market. So I believe that's it for today, guys. And it's always a pleasure. I'm sorry, you know how hard it is to talk a different language when you're not used to. I speak English in this coverages and in the live ones of events, and that's it. So it's pretty hard sometimes to find the correct words, but I really hope you understand what I tried to say, and I hope you enjoyed this live moment. I will be covering the Fed live next Wednesday, so hopefully see you back there, okay? Thank you and goodbye. See you soon.